Hello everyone, welcome back to my channel Munafa. My name is Pratyumna and I hope you all are doing well. Four main factors which have been affecting Indian stock market for the last 1 year. Russia-Ukraine war, inflation, Hindenburg's report on Adani Group and the collapse of US banking system. These four factors have been the hurdles for Indian stock market whenever it tried to make its new high. But the question arises that apart from all these negative scenarios, as a retail individual investor, can I invest into Indian stock market for the next 5 to 10 years as per the Nifty's current valuation? Or in other words, are Indian markets overvalued, undervalued or fair value? When we will put the future projection of Indian GDP and economy with today's valuations, we would have a clear path and we would be able to take logical decisions in terms of our investments. So one of Morgan Stanley researchers claims that India's share of manufacturing is expected to increase to 21% of GDP by 2031. Even in this chart, you can see the world's top 10 economies where you will find India's economy which is standing at number 5 with $3.47 trillion after surpassing the United Kingdom's economy. And you would love to know the fact that India's economy has jumped from $2.5 trillion to $3.5 trillion where India has surpassed France and UK's economies even after such negative international scenarios. Even the international agencies like IHS are predicting India to be the third largest economy in the world by 2030. And if it happens, we will surpass Germany and Japan's economy. Now if you look at Nifty 50 chart, it has hardly given any return in the past 1 year. Also the Buffett indicator which has fallen below 100 shows that the Indian stock market is fair valued. Now Buffett indicator is a ratio of market capitalization to GDP, which shows if the stock market of a country is undervalued or overvalued in comparison to its GDP. Warren Buffett says that the market share of listed companies should not be greater than the GDP of that particular country. If the ratio is between 50 to 75%, then the market is undervalued. And if the ratio is between 75 to 90%, then the market is fairly valued. And if the ratio is between 95 to 115%, then the market is overvalued. So in financial year 21, this ratio was 104%, and in FY22, the ratio went up to 112%, and now in FY23 the ratio is 92%, and for the financial year 2024 the projected market cap to GDP ratio is 84%, which is fairly valued. So now hope you are convinced that the valuations of Indian stock markets have fallen in comparison to previous financial year, and there is a big span left for Indian economy to grow. So therefore you should start accumulating into Indian stock markets as a long-term investor. And in today's video I will talk about one fundamentally strong stock from banking sector, but before that let me tell you that I am not a SEBI registered advisor and this video is made for education purpose only. Hence do your own due analysis before investing into any company. So let's get started. So the bank I will be talking about in this video is the Karnataka Bank. This small cap bank has given 146% returns to its investors in the last 1 year. This bank has a good banking experience of over 9 decades with a network of 877 branches across 22 states and 2 union territories. Now if you look at the gross NPA of the company, you will notice that it has reduced to 3.9% in the FY22. And even if you check the net NPA, that is also on a decreasing trend and at the lowest. Now NPA means non-performing assets, like a loan for which the principal or the interest payment is overdue for a period of 90 days. And now for the mitigation for those NPAs, let us look at the commentary by the management where Mr. Mahabaleshwara is saying that we are increasing the provision and the PCR, which is provisional coverage ratio. And further you can see in the commentary where Mr. Mahabaleshwara is saying that 93% of security coverage is there for our NPA, and despite that we have increased the PCR to 80%. Now assume they had given a loan of 100 rupees and it went bad. Now for every 100 rupees of bad debts, they have an asset backing of 93 rupees as a security coverage, and the remaining 7 rupees would still be the loss for the bank if it does not have any provision for that. But the Karnataka Bank has a PCR of 80% to back that loss of 7 rupees, and that 80% is not of 7 rupees, it is of 100 rupees of total loan given. Hence for now every 100 rupees of loan they have 93 rupees of security coverage and 80 rupees of provision coverage, means they have 173 rupees of security for every 100 rupees of loan, which definitely sounds good. Now where does those NPAs come for the Karnataka Bank? For that look at this pie chart where you will notice that in the retail segment the NPA has a major chunk which is almost 75%. Now they consider retail borrowers to them who borrow up to 7.5 crore rupees. Rest 25% NPA comes from mid corporates and NPA from large corporate is 0. Now, recoverability from retail borrowers is not that tough for the bank, and on top of that, they have security, and on top of that, they have good provisioning. And when those NPAs will be recovered, the provisions will be returned back. And with more money flowing in, the profitability of the bank is going to increase. Now, if you look at the financial highlights of the bank, the total advances have been constantly increasing, and so as the case with net profits, which is also have been increasing. Even if you check the net profit of past 3 quarters of FY23, it has already surpassed the net profit of FY22 with 825 crores, with one quarterly result is yet to come. Now, if you look at the deposits, these also have been increasing, and if you look at the CASA, which is current account, savings account, they are also increasing. Now, if the CASA increases, the cost of funding for the bank is going to go down and the profitability will increase. Also, the FII keep on increasing their stake in the company every quarter. Currently, the Karnataka Bank is trading at 135 levels, which is its major support. And also, the share is trading at 18% below from its recent high. So, technically, we can start accumulating into this bank, but before that, you need to understand that this is a small cap company, and small cap companies fall or rise more aggressively in comparison to large cap companies because of their high beta nature. But for a long term view, it can be a good bet according to my analysis, and I have already taken a position into this bank and will accumulate more with the time. So I hope you like this analysis, and if you want me to analyze any specific company, then tell me in the comment box and I will surely make a video on it. Also, don't forget to subscribe this channel and hit the bell icon to stay updated. I will see you in the next video. Till then, keep learning and happy investing. See ya.